What's up everybody? Nate here. So something crazy just happened in the housing market. After months of prices hitting new record highs and inventory hitting new record lows and mortgage rates essentially starting to get higher and higher and higher, it looked like the housing market was pretty much at a tipping point. However, as of March 3rd, 2022, mortgage interest rates in the United States have actually started to decline. Something that was completely unexpected in our current economy and market conditions. And with the spring housing market season just around the corner, the housing market over the next few months could be completely insane in the United States. So today I want to talk all about the housing market. Why are mortgage interest rates starting to decline right now? How long is that decline going to last for? And what is this all going to mean for markets in the future? But before I break all of this down, do me a quick favor and hit, smash, or destroy that thumbs up button below and ring that notification bell too. Both of those two things are completely free and they help to show me that you like this video and that you want to see even more just like it. And while you're at it, give me a follow over on Instagram at I am Nate Gregory and over on TikTok at I am Nate Gregory as well. Thank you so much for doing that. And now let's talk all about the housing market in 2022. Now, since the start of 2022, mortgage interest rates on average in the United States have risen by a full percentage point. However, right now they are starting to decrease. As of mid-February, the average interest rate for a 30-year fixed mortgage was around 4.18%. However, it is lower than 4% right now. It actually sits at around 3.9%. And that's literally over just a couple weeks. Now, that is one of the biggest drops that we've seen over the last 2 years. In fact, this percentage drop that we're seeing right now is the fastest drop since March of 2020. And March of 2020 was kind of the whole catalyst that kicked off this entire housing market spree. Now, what else is going on in the housing market right now? Well, we have extremely low inventory and extremely high prices. In fact, in January 2022, on average, housing prices went up year over year by around 19.1%. That's the fastest and highest that we've seen in around 45 years. And after things got super crazy in March of 2020, the housing market has been insane. We've seen record low rates, extremely high prices, and next to no inventory. And that has all led to a hot housing market in 2022. With rates starting to go down though, the housing market might get even hotter. So what exactly is going on? Why were rates starting to go up and why are rates going down right now? Well, interest rates are directly tied to what investors are doing and what the Federal Reserve does in the United States. We're starting to see investors in just about every category get a lot less risky with their asset purchases. So they're not putting as much money into the mortgage-backed security market, and in turn, the Federal Reserve isn't putting as much money into mortgage-backed securities either. Mortgage-backed securities are essentially a group of funds that are tied to all of the mortgages in the United States. And the Federal Reserve has been buying billions of dollars worth of mortgage-backed securities every single month. However, that was all part of their quantitative easing program, which they started when the pandemic first began back in March of 2020. They essentially wanted to lift the stock market out of one of its fastest crashes we've ever seen. And in a lot of ways, it worked. However, by March of this year, they now want to pull all of that money from the stock market, meaning there's a void that investors need to fill now. Investors are starting to fill that void, and they're also investing a little bit more into treasury notes right now, which means they're essentially giving the United States government money and the government is paying them back with interest. That all signals to our economy and investors that spending in the United States is about to get a little bit tighter. Now, let's talk about the opposite side of mortgage-backed securities, your financial institutions, so banks and credit unions. These are the ones that actually do all of the lending. So when you go to buy a house, chances are you don't have hundreds of thousands of dollars lying around in order to purchase that home. You have to get a mortgage. And that's just basically a loan from the bank in order to buy a house. When you get that loan, you're going to be assessed an interest rate. Now, the interest rate is going to depend on a lot of different factors. Like I said, whatever the Federal Reserve currently has its interest rates at, that is going to affect the amount that banks can borrow their money, which is going to affect the amount that you can borrow when getting a mortgage. It's either going to be very easy or it's going to be very hard. Like, let me give you an example. Back in March and April of 2020, the Federal Reserve dropped its benchmark interest rates down to 0%. So it was really easy for millions of Americans to get a mortgage right now. Because interest rates were so low, that meant that millions of Americans were going to be saving hundreds of dollars on their mortgage every single month. And then they could use that savings to buy other things in their lives, pretty much anything they wanted to. And obviously, that pushed the housing market up. And the whole idea behind this was to incentivize spending in our economy. Federal Reserve and the United States government didn't know what was going to happen with the pandemic and all of these economic lockdowns, so they made it really easy for people to go out and spend money. They gave out thousands of dollars in stimulus money, and then they also had low interest rates, so that way anybody in the United States could spend even more money through loans and even credit cards. Well, that was back in 2020. We're now in 2022, and pretty much all of that has now changed. Stimulus is done for. Interest rates were starting to go back up, and the reason for that is because it looked like our economy was finally beginning to recover from the pandemic. It looked like virus cases were going down. It also looked like wages were starting to increase a little bit. Jobless claims were relatively positive, and the Federal Reserve announced that it was going to start raising its interest rates in March of 2022. So banks then started to raise their interest rates so they could get ahead of the curve. But here's what changed though. War. The war between Russia and Ukraine has caused a serious dilemma for the housing market in the United States. And I know what you're thinking, how does a war all the way across the world affect the housing market here at home? Well, the first thing you gotta keep in mind is that banks are universal. So all of your major banks throughout the country are also throughout the world. So they're lending a ton of money and they're getting a ton of money from a lot of different resources. Right now though, the war between Russia and Ukraine has put so much on ice, and banks are not really sure how they're going to be able to continue with Russia basically closing off all of its resources to the United States. In addition, Russian banks and Russian stocks are not really doing well right now. In fact, they're all completely tanking, and the Russian economy is tanking, which is hurting markets all throughout the world, including currencies. There's not as many US dollars circulating, which means banks are taking a hit. And what that ultimately means is the United States economy is taking a hit. You see, Russia has a ton of resources like oil, precious metals, and wheat. All of those are pretty important industries in the United States too, and we can't get any of those resources to make products or services. If none of those can come over here, then there's going to be a scarcity issue. You're going to have supply and demand that is all thrown off. And it's pretty much already thrown off because of the pandemic over the last 2 years. That means inflation is most likely going to continue to rise. And in short, the prices for just about everything are going to go up because businesses are having a hard time getting things. And some consumers, as they're starting to make more money now, can buy a lot more, but there's just not enough to buy. That leads our economy into something that's called stagflation, where you have inflation going way up, but your economic output is way down. Now, banks and financial institutions are kind of realizing this, and they're realizing that people are not able to buy things like they used to just a few months ago, which means our economy might not be recovering as well as a lot of people may have hoped. So with that fact, banks are starting to lower their interest rates so they can make it a little bit easier for buyers to get a home. They don't want to lose a ton of income because remember, housing prices are at a record high right now and inventory is super low, making housing prices go up even more. And we're going into the spring and summer season of 2022, which typically is the busier time for the housing market in general. Because it's a busier time, it's busier for everyone. People are out and about and moving, and a lot more sellers tend to put their house on the market. Dropping interest rates gives buyers more buying power, so they can go out and get a bigger house and a bigger home. That gives the banks more money, and then it gives those mortgage-backed securities a lot more money too. As the Federal Reserve starts to pull its money from those mortgage-backed securities, individual investors are going to put their money back into that fund. When they do that, they want to start making some money. So banks and financial institutions dropping their interest rates and then pushing people into bigger houses by approving them for larger mortgages might end up filling that void. Now, all that's not a guarantee. tea, but we also have to talk about what the Federal Reserve is doing. Now, the Federal Reserve is taking a super close look at inflation in the United States and also the Russia-Ukraine situation. Chairman of the Federal Reserve, Jerome Powell, has talked a lot about what they plan to do with their interest rates. And right now, it looks like they're going to raise their interest rates by a 1/4 percentage point on March 15th, 2022. As they raise their interest rates, they're going to eliminate a lot of that demand that they created back in March of 2020. It was easy to spend then, and now with them raising their interest rates, it's gonna be a little bit tougher. Now, what does this all mean for the housing market in 2022? Well, it kind of depends, because if this Ukraine-Russia conflict continues to escalate further than a lot of experts believe it will, well, then we could continue to see mortgage rates drop in the United States. In addition, if anything else happens in our economy that kind of prevents people from spending large quantities of money, like the pandemic or a possible recession, then that could pull back interest rates even more. In addition, you've got the Federal Reserve. Now, like I said, the Federal Reserve wants to raise their interest rates by a 1/4 percent, but they're going to keep an eye on inflation in the United States. They may end up needing to get a lot more aggressive with inflation because of the Ukraine-Russia crisis. What they have to do is keep prices stable in our economy. If people just keep having to spend more and more for everything, but they're able to buy all the same things because they keep making more, well, that's kind of a dangerous system because the value of your money is going down way too quickly. That reduces buying power, which in turn makes your currency pretty much useless. We're starting to see this right now in Russia, as the Russian currency, the ruble, is currently worth less than 1 US cent. So the Federal Reserve may need to remove that demand entirely in order to bring our economy back down to a normal price stability level. And that could be in the short term, or it could be in the long term, or it could be completely reversed. We could have the Federal Reserve actually not raising interest rates at all after March, and we could see rates continue to drop in the United States. If this Russia-Ukraine conflict ends, though, then you'll most likely see a more aggressive Fed and a mortgage interest rate market that goes back up. That'll put a lot more strain on buyers, and they were already extremely strained from the start of this year. As mortgage rates were going up, it was nearly impossible to buy a home because prices were at an all-time high and inventory was at a generational low. And even if you could find a house to buy, like I said, it's extremely overinflated in value. And then you have to pay a much higher interest rate on top of that, meaning homes were pretty much unaffordable for most Americans. That's starting to switch again as mortgage rates go back down, so Americans can start to buy those more expensive houses, leading to higher prices in the housing market and even less inventory. And again, if that's in the short term, then you won't really see too much change in the housing market because that's pretty much where we're at right now. However, in the long term, this could absolutely devastate the market because now interest rates are going to continue to go down. So Americans are going to be able to buy any house they want because of all of the savings they're getting from low interest rates. Even if housing prices continue to go up, that's okay for some Americans because they can afford it. Inventory just will not keep up though, so you'll most likely continue to see bidding wars on every single home. With that being said, with interest rates going down as well, you'll probably see more real estate investors and real estate investment companies enter the market and push a lot of your traditional and regular buyers out too. And of course, the other side is if everything is completely reversed. If we start to see interest rates go back up in the United States, that means buyers are basically going to disappear. You're going to have lower mortgage application rates, which means there's not as many people in the United States looking for a home. If you have houses sitting on the market for a long time, then naturally they're going to start coming down in price. And as less people are buying homes, then your inventory will go back up. And your supply and demand will kind of fix itself from there because then you'll have a lot more supply and a lot less demand, which means housing prices will go back down. There's a good chance that'll happen in the long term because the Federal Reserve is raising its interest rates, meaning no matter what, banks are eventually going to have to raise theirs. They can't keep them low forever because it's going to be really hard for them to get money too. So they're going to have to be really careful on who gets a mortgage and who doesn't. But like I said, in the short term, the housing market is going to continue to be on fire. How long it lasts depends on the Federal Reserve, our markets, and the Ukraine-Russia situation. But now I want to hear from you on this issue. Which direction do you think the housing market is going to take in 2022? Do you think that mortgage interest rates dropping is going to be a permanent thing? Or do you think it's only in the short term and rates are going to go back up very soon? In addition, is the housing market in 2022 going to continue to be red hot? Or is the Russia-Ukraine war and the Federal Reserve ultimately going to crash it? Whatever your thoughts are, leave a comment below before you go. But that is it for today's business and financial news breakdown. Thank you so much for watching. If you want to stay up to date with all of the top business and financial news from around the country, our team puts together a free daily newsletter, and you can subscribe to it by clicking the link in this corner right here. And if you want to stay up to date with me, be sure to follow me over on Instagram at I am Nate Gregory and over on TikTok at I am Nate Gregory as well. And of course, if video is more your thing, I'm putting out updates 7 days a week over here on this channel, and I've actually got one ready for you right here, so be sure to check that out before you go. That is it for me, everybody. Be kind out there, and I'll see you all in the next one.